Hello, and welcome to another episode of Going the Distance with Go Long. Go Long is an accountability coaching service, and we coach via text. So you get those daily nudges so that you could stay on track and do the things that you really want to get done to make time for the things that matter to you. I am Jill Consor Beck, and I am here with Suzanne Scheer, and we're going to hear about her story in a bit. We're going to be talking about long-term care insurance, and right now, long-term care insurance is very much front and center in my life because my mom has Parkinson's and she took a fall, and we are needing to leverage some of those benefits that my parents have paid into for a significant amount of time. All right, with that, Suzanne, welcome to the show.
Thank you so much for having me, Jill.
This was actually scheduled, like we were scheduled to talk before my mom fell and had this recent thing. And then obviously it took on more priority in terms of understanding the mechanics of this once she fell, and then we had like our prep conversation. Suzanne, why don't you tell everyone how you got into what you do?
Sure. So it's not a direct path like a lot of people. So funny enough, my dad actually was a life insurance agent for 50 years. So I grew up around it all the time, but didn't have the interest in pursuing that as a career. I wanted to do law. I wanted to help women who weren't being treated right. And so I did family law for a time. And then after my son was born, he had some little health hiccups. And so I needed to work part-time. And then a few months, or like, I guess maybe another year or so into that, my mom fell and broke her hip. And when she did that, she hurt her spinal cord, which impacted her hands. And so she couldn't write. So I took over my parents' finances and helped. My son was 15 months old. I was 33. And I just stopped working because it was just too much between everything going on. And went through, helping my mom. And I was the only child. So it was all sort of on me. And then a few years later, my dad had a stroke, and then he had end stage dementia just come upon him all of a sudden. So it was about an 8-year period between both my parents where they were having health issues, and they passed 5 weeks apart in 2010, which was really hard. So I took a little while after that to become a person again, because even though I didn't physically do the care for them, I was overseeing their care and help, just coordinating and going back and forth between the two of them. And luckily I was local, but still they were different places for a good part of the time, because towards the end, my dad was in a dementia unit, my mom was home. So like I said, I'll go into some more detail, but caregivers, you put yourself last and you don't really feel like a person when you're going through that. But in any event, I got through that. And a few years later, when I was ready to go back to work, I pivoted and became a financial advisor. And as part of that, I've been doing insurance. So that's been since 2015. But I would say in the past, maybe 3 or 4 years, I've just really gotten hyper-focused on the long-term care insurance because I see that people aren't thinking about it. They're not addressing it. I went through it very young because my parents were older when they had me. So I saw it, my 30s and early 40s, whereas most of my friends now, in our 50s are starting to have issues more so with parents. But it's sort of like, I don't know if you liked the movie Say Anything, but there was that speech, I can't remember the girl's name in the movie, but when she gave her valedictorian speech, she said, "I've
Diane
glimpsed
Court.
Yes, exactly, Diane. Oh my God, how did I forget that? So she said, "I've glimpsed our future," and I feel like I glimpsed the future when I went through all this in my 30s. And I'd be in the nursing home. People probably thought I was my dad's granddaughter, not his daughter, and it was just a weird thing. And then the dichotomy between that and then going to be with my son at a birthday party or doing happy things, going from the dementia unit to the pool or, anyway. So I went through all the things, but I really think that people are not stopping to think about long-term care insurance. They hear bad things about it and they just assume it's bad and they just sort of write it off, or they think, oh, it's unpleasant, I'm not going to deal with that. So I've just really gotten hyper focused on it because there's some really good options and people don't know about it. And I feel like I've got these secrets that I want to share with the world. So it's gotten me just really excited about it.
Well, we want to get all the secrets. We want you to spill the tea. I
Yes.
think it's kind of funny you mentioned Say Anything because I think Diane Court's dad got like indicted for like tax evasion for like Medicare
Yes.
fraud or something like
Right.
that with like a
Yes.
nursing home of some
Yes.
sort.
Yes.
So,
You're right.
I mean, there's Say Anything clearly had this huge impact
Oh
on
my
your current
God.
career.
Yes. Absolutely. I love that movie. Yes.
A very interesting career path. and you hit the sandwich generation at a very young age. So you were ahead of the curve, as you said. You saw the future. And now probably a lot of your friends are going through this now. And
Yes.
this is like a two-pronged discussion, because the thing is that there's how do you manage your parents' situation? But then
Hmm.
there's also like talking to people who are in their 30s, 40s, and 50s. Should they also get long-term care insurance? So I want to cover
Right.
both of those angles, not just like say, oh, this is what you have to deal with when, you know, it comes to your parents and
Hmm.
seeing, what their situation is if something, happens to them, but
Right.
also kind of giving people a rubric of evaluating should they get long-term care insurance for themselves. And before we get into that, I want to say that none of this information in this episode is meant to be legal or financial advice. This is not establishing a fiduciary relationship of any kind. This is for informational purposes only. If you would like to engage with Suzanne, we will have her contact information in the show notes. All right. Suzanne, what do you think is the number one thing that people don't understand about long-term care insurance?
Well, so many people think that Medicare covers it. Something like 50% of people think that. There are survey after survey. 50% of people think Medicare covers it. They think that it's already covered by insurance that you have in place, but it's not, because long-term care by definition is custodial in nature, which basically just means the things that you do every day that you probably did this morning to get ready for you got out of bed, you went to the bathroom, you took a shower, you got dressed, you ate, and then during the day you maintain continence. Those are the 6 activities of daily living. And if you can't do those safely, either by yourself or without someone there supervising you, or if you need assistance because of a cognitive impairment and it's expected to last at least 90 days, whatever's causing this problem, that's considered a long term care event. So all those things are custodial in nature. None of them are medical. They don't require a nurse or a doctor. They just require a person to help. And so because they're not medical in nature, they're not covered by health insurance and they're not covered by Medicare. And people don't know that. If somebody is 65 or older, they're on Medicare, let's say they have a stroke and they go to the hospital and they're there for 3 days, then they needed rehab afterwards, they would get the first 20 days paid by Medicare 100%, and then days 21 to 100 would be paid 80% by Medicare, assuming that they progress with physical therapy or speech therapy, whatever kind of therapy they need. So they could potentially get kicked out during those last 80 days, or they could stay. But then once that 100-day period is over, then they're on their own. So what are they going to do if they need help with those activities still? They're going to have to pay a person to either come to their house and help them, or they're going to have to go to assisted living or go someplace to get this help. And they don't already have insurance that's going to cover it. So they're going to have to dip into their savings, their portfolio, sell a house, do something to raise that money, unless they happen to just have a pile of $10,000 or $20,000 sitting around each month,
Yeah,
right?
yeah, we're going
Most
to get
people
into
don't have
that.
that.
So there's one thing I found out with this situation with my mom is
Hmm.
that it's very important that my mom got taken to the ER, but how she's admitted is also very important in terms
Yes,
of when Medicare kicks in or not. So
right.
if she's kept in the hospital for observation, even if it's for that, like say 3-day period,
It wouldn't count.
it wouldn't count versus she has to be admitted to the
Admitted.
hospital.
Yes,
Is that
yes,
right?
yes. You're right. Yes, she
So
needs
I
to be
think that's
admitted.
important
Uh
for
huh.
people to understand. It's a very
Yes.
important detail, but it's
Hmm.
something that you need to, because otherwise you will get a bill
Right.
for
Big
that.
bill.
And also, Medicare won't cover it.
Right.
The other thing I want to ask you quickly, just to make sure for people here, what is the difference between Medicare and Medicaid?
That's a great question.
I think people mix them up a lot, or they think they're the same thing.
Right. No, great question. So Medicare is the health insurance that kicks in when you're 65, or for certain folks with disabilities, it might kick in earlier. But generally speaking, it kicks in when you hit 65. And that's your health insurance. But Medicaid is for folks who are impoverished down to about $2,000 of assets. And where it comes into play with long term care is that if somebody needs care and they're now down to $2,000 of assets, then they could potentially qualify for long-term care, but they'd often be put into a nursing home without much say as to where they go. But that's Medicaid is for folks who have very little money
Right,
at all.
who really don't have any material assets.
Right,
Okay.
right.
All right. So, is there ever a situation where you're like, yeah, you're not a good candidate for long-term care insurance?
Yes. So if someone doesn't have enough money to afford premiums, if it would be a real hardship for them to pay the premiums, then it does not make sense at all. They probably will be in the situation of needing to go and spending down their assets and going on Medicaid. But when we're talking about folks who have, enough money to be able to pay for the things they need, they have an emergency fund, they have savings, and they're looking to preserve their assets if they should need care, then that's really when it starts to make sense. So, but I mean, there's not really a hard line. I mean, if you're barely paying your bills, if you're living paycheck to paycheck,
Right.
then it wouldn't make sense because you wouldn't be able to maintain it beyond a very long time.
So, I've heard people talk about, say, self-funding,
Hmm.
but let's talk about the math around self-funding and what that comes out to, say, per month and per year in like a major metro area. We can take, I think you're in the DC area, right?
Yes, yes.
DC, New York. I'm in Seattle. What does it come out to per month? If someone's like, oh, I think I could self-fund this.
In terms of how much the care would cost
Yeah.
if they need care, I can tell you I have a client who was in a one-bedroom assisted living in Bethesda, Maryland, which is a suburb of Washington, D.C., and he was paying about 15,000 a month for his care. And fortunately, he had a long-term care policy he bought before we started working together that has an unlimited benefit, and it was paying for all of that. But he didn't like the fact, which I don't blame him, um, with assisted living, maybe there's one caregiver assigned to 10 or 12 people on the floor, and he liked to have somebody there if he needed something.
Right.
He didn't wanna wait for 45 minutes. So his long-term care was paying for his room and board and his assisted living, but he was on top of that paying a caregiver thousands of dollars every month to be there for him in addition. But that's not the usual situation. That was his situation. He was able to afford it and do that. But taking that aside of the fact, 15,000 a month for that particular facility, a nursing home could be somewhere around 20,000 a month. Now, there are other places that are not as fancy and they're not in different areas of the country. I mean, there's a huge, I was just talking with a client today. There's a huge variation if you look and see what it would be in Utah or in Florida or in different places around the country. It's going to vary substantially, but I would say at a minimum, probably 8,000 a month, but maybe up to 15,000 a month for assisted living. For home care, it's about $40 an hour with an agency where I am. And so if you did 44 hours of care a month, it's about 7,000 a month. So, I mean, we're talking even with home care just for a short time, that's a significant amount of money that most
Yeah. I
people
mean,
just don't
$40 an
have.
hour times 40 hours a week,
Hmm.
right? Times 4 weeks a
Right,
month.
right. It's about 7,000 ish
Yeah.
a month,
Times
give or take.
12.
Right,
So my parents got their plan 25, 26 years ago.
right.
And my understanding from their broker, who I've had now numerous conversations with to make sure that I understand how to like get involved and do a
Hmm.
bunch of the paperwork and everything, is that they don't make those plans anymore. Like
Correct.
because there's an unlimited benefit and everything else.
Hmm.
And I'll get it. I have some questions specifically about that. But just in general, if someone's coming to you now about a plan,
Hmm.
what should they be looking for?
Gosh, good question. So just backing up one second, I just want to
Yeah.
say this real fast. When the plans first came out, the actuaries really fouled up. They made a lot of mistakes. They thought people were going to let their policies lapse. They thought interest rates would stay high. They didn't count on people living so long. And so the policies that were issued 30, 40 years ago, the benefits were way too rich and the premium was way too low. And it wasn't sustainable. And especially when only 1% of people let their policies lapse. So all the assumptions just were so wrong. So that's why the old policies have such big rate increases because they
Yeah.
were not priced right. But it, because of all that, went from maybe 100 plus companies in the long-term care market for they call them either traditional or standalone policies. So we're maybe 150, 100 and some companies in the market. Now there may be three. So it forced a lot of companies out of the market, and it completely changed everything with how things are done. But today, in response to the problems that existed with those policies, um, there are now these newer kinds that are referred to as what they call asset-based or hybrid or linked benefit. So the older kind, the traditional kind, it was a use it or lose it policy. You paid a bill. If you never needed any care, there wasn't any money that would go back to your beneficiaries. You just paid the bill like you'd pay your car insurance or your homeowner's insurance. And the other thing that was really tricky with those old policies is that the premiums were not guaranteed level.
Yeah, my
So
parents
you might,
experienced that.
right? So you might pay $250 a month when you get the policy, and then all of a sudden, when you're on a fixed income in retirement and you don't have very much money, you get this rate increase, and then you're stuck with a decision of, do I keep it, or do I
Yeah, you're
drop it, or do
fucked.
I adjust it, or do I eat, or do I keep my
Yeah.
long-term care, right? So anyway, that's why there's such bad taste in people's mouths about long-term care, because of those experiences. But now there are these hybrid plans which are completely different. And it makes me crazy because people base their judgment of long-term care insurance as a whole on those problematic policies that, although they were very rich in benefits, like we were talking about, they had these increases, which people didn't
Yeah.
like. So the newer policies have a combination, typically an insurance policy as like imagine two buckets of money. The insurance policy is the first bucket, and then it's linked to a second bucket that's an extension of benefits. And the thing that's so nice about that is when you get the policy, if you never need any care, the money that's in the insurance bucket goes to your beneficiaries tax-free when you pass away. And if you do need care, you know what you're going to get. There are no rate increases. Everything's set when you get your policy. So it's very much in line with what I like, which is not to have surprises. I don't like financial surprises. I like to know, right? Like having a fixed rate mortgage versus an
Yeah.
adjustable rate mortgage, right? Like you know what you've got. And you get
Apparently,
the
adjustable rate mortgages are coming back in
oh,
style, which is terrible.
that's crazy.
Yeah.
But that's a whole
Anyway,
nother.
we digress.
But yes, but the thing with is so nice is that, you put in a certain amount of money, you get all this leverage right away. Like, so I can give you an example. I got a policy a few years ago where I'm putting in $1,000 a month for 10 years and then I'm done. So I'm putting a total of 120. Day one, when I made my first $1,000 payment, the bucket of money I had available was about $500,000. Now I couldn't get that all at once. It's doled out on a monthly basis, but like that's the leverage I got. And then when I'm in my 80s, God willing, it'll be somewhere worth $1 million. So all from the 120,000. And then if I don't need any care at all and I pass away, then there's a $140,000 death benefit that goes to my
Yes.
beneficiaries.
Yes. That's what my husband and I each have something similar where there's a payout if we end up not leveraging the benefit.
But but people say the self-funding, getting back to your question about self-funding, people say, oh, well, I'm just going to take that money and invest it. Well, there's no way you can invest $1,000 and immediately have access to that huge bucket of money for care. You just can't. I mean, it's going to take you time and there's risk involved. And you have to have gains every single year without interruption. And it has to always go just right in conjunction with when you might need it. And who knows if the market is down and you need to take money from your investments to pay for care and you take it out at a bad time. I don't know if you know about sequence of return risk, but I mean, if you start taking money from your accounts when it's down, it just sort of throws everything off.
Sure.
So,
Sure.
so anyway, that's a long answer to your question, but you know, it's it kind of blows my mind that people just are told, okay, well, you have enough money, you can self-fund, and they don't even ask the question, well, what are my options? And where's the money going to come from? What's going to happen if I need care? What's going to come out first? What would be the impact if I have to take money from a retirement account or from an investment account or sell my house or take from home equity? Like, what are the tax implications? What are there's just so many things.
I think in our case, you know, my husband had a severe brain event, neurological event. And so we were shaped by that. And I knew my parents had long term care for themselves. But
Uh-huh.
I I believe that we were very much shaped by that experience,
Uh-huh.
and we knew to ask the questions. But I don't think that, knock wood, most people didn't go through what we went through 11 years
Right.
ago
Right.
as a couple. So I think so people don't think that something that catastrophic can happen. They think about life
Right.
insurance
Right.
as a payout. I don't think they think
Mhm.
about long-term care insurance. They don't think about what can happen unless they've been shaped by something like a parent where
Right.
they had to navigate all this, and then they think like, "Oh, what's our situation?"
Right. Right. Exactly.
So when someone is thinking about this and they're
Mhm.
trying to think of what I always think about when purchasing something as major as this are the different levers
Right.
that are in place in terms of what am I trying to achieve.
Mhm.
And I was actually talking to a friend just now on a business related topic, and we were talking about like you never just optimize for one metric. So what are
Right.
the different metrics levers that one should be thinking about if they're considering a purchase like this? Because it's a major one.
Yes, you're right. Great question. I think you wanna look at your overall picture, overall net worth, where do you stand in terms of savings? Do you have an emergency fund? First of all, is really important to make sure that you're in good footing. And then, if beyond an emergency fund, you have, life insurance and potentially disability insurance in place, depending on your situation. But, look at, okay, well, what would happen if we needed care? What assets do we have and what would we draw on? And, looking at, okay, well, we have a certain amount and we could supplement some of it, but what would we need so we wouldn't have to completely eviscerate our portfolio? So, look at what would be the monthly benefit amount. Let's say let's say 30, depending on your age,
Right.
83
Sure.
is the average age of claim. So we usually look at, okay, what would it be at 83 in terms of the monthly benefit and the total payout? And just looking at it in conjunction with your net worth and what you have and how your portfolio is set up to figure out, okay, well, what do we need? I mean, we're not going to, the thing with long term care insurance, it's not going to pay for everything. It would be cost prohibitive to get a policy. It's going to pay every penny. But
Right.
let's say you want to pay 60 or 70% of the care if you needed it. How much do I have that I could use to supplement? Like if I have, a certain amount of money, like, okay, well, what I need to be able to pay a good chunk of the long term care if I needed something, but not every penny because I would know it could take some from my own assets. I don't know if that's answering the question, but so like looking at what would your total benefit be in exchange for how much you'd have to put in.
That does help. I think you brought up something interesting that I want to ask a follow-up question on. You said that it's cost prohibitive to get a policy that covers everything. So what
Hmm.
are some of the expenses that people should be thinking about that even if you have like a decent long-term care plan, that you would still have to cover out of pocket?
Well, if let's say it is, if today it's average, maybe you'll call it 700 $9,000 in Maryland or Washington D.C. area for care, and then it's expected to be, let's say, you know, 15 or no, probably like let's say 20,000 years from now. Like
Mhm.
look and say, okay, well, I wouldn't have 20,000 extra a month, but I would probably have 13 or 14,000 extra a month, so I could take money from Social Security if it's there,
Mhm.
which we don't know. That's a whole
Right.
unknown. If
I
it's
just recorded an episode on that, so I don't think it's going to
yes,
impact Gen X and the boomers as much because I think they're going to just move the age. I think
right.
it's gonna hit Gen Z, and they're gonna be even more pissed at us than they already are.
I know, right, definitely. But like, so you have to look at, okay, well, potential Social Security, if you're lucky enough to have a pension for some of the folks who
Mhm.
do, look at your savings, look at your investments, what kind of required distributions will you have to take from your retirement? Just kind of look at them together and say, okay, well, if I put these two together, I would have this much money per month, and like, what would be a reasonable amount? So it's sort of a calculus of balancing out because not everybody's going to need long term care. I mean, that's the other
Yeah,
factor that you might be lucky and never need it, and so I really like the idea of these hybrid plans because if you don't use it, you haven't paid money for something that you're never gonna use. So or
yeah,
you don't get it back, but if you know that your beneficiaries are gonna get it back, at least you feel
yeah. I mean,
better
I hope I
about
go
it.
quick. I hope when it happens, I hope I go quick.
Right, I think everyone would like that.
Yeah.
I think you're right.
Wh- One of the things that I think about, you said you don't like surprises. So almost let's think about this like you go to quote unquote an all inclusive resort, but then you could
Mhm.
find out that there are extras you can get that are not part of the all-inclusive at the
Uh-huh.
resort. So are there examples of expenses in, like, an assisted living type of situation that people are gonna probably wanna pay for? Like that example you talked about with the gentleman who wanted an aide,
Uh-huh.
you know, more, to give him more personalized attention, right?
Right.
What are some other examples of those extras that you may want at the all-inclusive resort but aren't included in the all-inclusive
Right.
package?
It really a lot of times it depends on the facility. I mean, sometimes they'll have a hair salon or they'll have, you know, place you can get a manicure or a
Mhm.
haircut or different things like that. Some of those incidental things would probably not be covered by long-term care insurance, but they're usually, I mean, comparatively minor. It really depends on the facility. Sometimes they might even charge for, like, if someone's not continent, they might charge for those products potentially separately. Long-term care should pay that, but depending on the circumstance, sometimes people don't want to go to the dining room, and sometimes the facilities will charge them to bring meals to their room, which to me seems crazy. But you know, there'll be some random charges that will come along. But I would say, for the most part, most things aren't covered within long-term care, assuming but your policy might not be as much as the cost. So, like, if the assisted living is 15,000, your long-term care is paying 10, then you're looking at having to make up the difference that way. But in terms of things that are included, I think they're pretty decent about most things being covered.
Alright, so there's gotta be situations where one person in the relationship needs more care than the other person, and I'm not talking about the memory care unit necessarily, I'm talking about
Uh-huh.
living in, we'll say, an apartment-like situation where one
Mhm.
person really needs to be there, but the other person doesn't, but they're choosing to live together.
Right.
How does that typically work in terms of the funding of that?
Like in an assisted living scenario
Yeah,
or in
assisted in
just
an assisted living scenario.
unfortunately, a lot of the time they will charge quite a lot for this healthy spouse to be there. I mean, it could be $1,000 a month, $2,000 a month extra, and
Mhm.
that wouldn't be covered by long-term care. So that
Right.
can be problematic. I've seen that come up occasionally, and that's kind of unfortunate because, you know, the couple wants to be together a
Yeah.
lot of the time. But I mean, they can do it, but you know, because I guess they're going to be getting food and other amenities, and so they're being charged
Sure, I
separately for
mean,
that.
yeah, it just you'd have to pay that out of pocket for the spouse who wouldn't
Right,
qualify for long-term care insurance. You'd be paying
right.
for that out of pocket.
Mhm.
In terms of at-home care, right?
Uh-huh.
There's hourly, you're employing an agency and they do hourly work typically. What are the things to be thinking about when you're engaging with an agency to work with your family member at home?
A good question, and it's so hard because it's such a difficult thing to find a good fit, you know, with the
I just made this
personalities.
decision for my mom and I'm scared shitless. Like
Mhm.
legit. I'm not even like joking around. I This is like
Right,
probably one of the biggest decisions I feel like I've ever made in my life because like if
right,
it's not a good fit, I'm going to feel absolutely terrible. And I am immune to guilt, but I will feel absolutely
right.
terrible if it is
No,
not
I
a
hear
good fit.
you. I hear you. I mean, the biggest thing I think is to get recommendations from people who've actually used the agency and to not be afraid to say, you know what, this person isn't a good fit. Can you try someone different? Um, Even if you have to go through several people until there's a good fit. Because I mean, it could be anything from you don't like their perfume, or you don't like, or like, there could be all kinds of different things. So just it's such a difficult thing for people who are in the situation of needing care because so many of them, you know, they've lost their independence, they've lost a sense of control, and then here's somebody coming in their house who's a stranger,
Yep.
and they don't want to have them there. They don't want to be in that situation, and so they're already. It could be the best caregiver, could be an angel from heaven coming down and
Yeah.
just being the sweetest, kindest, most wonderful person you've ever met in your life, but just coming in they've got the deck stacked against them because right? You don't want nobody
Yeah.
wants to be in that situation.
My mom is already saying, she's like, I don't think we're going to need someone here that much and everything else. But
Right,
no one
right,
feels comfortable for her own safety leaving her alone.
right, right. So I would say get recommendations from people who have actually used the agency before. If you can get the name, let's say, you had a friend who used XYZ agency and the caregiver that their family member used and, they came recommended. I mean, that's ideal if you can do that. If you can't, just try to meet with them ahead of time if you're able to try to see, do they have a kind demeanor? Do they show up when they're supposed to show up? Are they professional? I mean, it's hard. I mean, we had a very difficult time with both my parents finding good caregivers, and it's there's really not a magic. Well, I wish there were an easier answer other than just having to go by recommendations and just be, clear in what your mom wants as far as and letting the caregiving agency know here are the things that are going to be pain points for her and, here this is her personality and this is where she's coming from and maybe letting them know as much as possible about her so that they can try. I mean, I'm sure they deal with this all the time because nobody
Yeah, I
wants to
mean,
have
they're
someone.
doing an assessment and everything
Right.
else, and
Uh-huh.
my dad is conveying the qualities of my mother,
Right.
and where she's at from a mental
Right.
health perspective,
Right.
because that is obviously very important at this
Yes.
juncture. What I was thinking about before, and I wrote it down this time,
Oh, good.
is continuing on the split parent situation where one person may need more assistance than the other person. So let's
Uh-huh.
say one parent decides to age in place, but then the other parent, I mean, in my case, parents, my mom may have to stay someplace and my dad wants to age in place.
Right.
The problem is that to get into a lot of these places, these assisted living facilities, they're extraordinarily expensive in terms of the buy-in, right? And then the fees, and then a lot of the wealth that my parents and that a lot of people have may be in their house.
Right.
And so you're kind of playing almost a shell game of how you're moving around the assets so that you can have the one parent age in place, but
Right.
somehow pay for that.
Uh-huh.
And I know there are certain estate planning things that you can do with your assets in terms of trusts and everything.
Right.
So maybe can we talk a little bit about that in terms of how that works and that things that people should be thinking about? Because it isn't like magic that like, oh, hey, you can put everything in a trust and everything is protected on day one. There are look back
Right.
periods and everything else.
Yeah.
So can
Yes.
we like just get into that? Because I think this is a really important thing for people who are in the sandwich generation, who are thinking about making all of these movements to protect their assets.
Right. No, great point. Well, one thing I'll say is that the facilities where they require you to have a big buy-in typically are what they call CCRCs, continuing care retirement communities. And those have where you start off with I'm sorry, with independent living. So you have to be healthy when you move in. But you can stay at that same campus and progress through different stages should you need it. Like if you did need assisted living or memory care or skilled nursing, it's all in the same campus. Maybe not the same apartment, actual unit, but it's within the campus. But that's been popular for a while, but I've been hearing about scenarios where those facilities have filed for bankruptcy.
Yeah.
So I'm a little bit nervous about those facilities because, like you said, you could be taking all the proceeds from the sale of the house, putting it into this facility. And then the idea is when you either move out or pass away, that, potentially some of that could get returned to the family. But I would be very hesitant, just generally, whether it's either two spouses or one spouse, I would be really nervous about that just because you don't really know what's going to happen and you're putting all of your money in. And then if they go under, you're pretty much out of luck.
Right.
So what I would recommend is there are a lot of facilities where you can pay just a month to month fee and you're not buying in. So I would say look into those facilities if you can, if they're available in your area, because that way, I don't know, maybe they require a year lease, or sometimes it's month to month, depending on the circumstances. But that way you're paying a monthly amount. You're not giving them all of your money
Yeah,
and being
that's the main
vulnerable.
thing is that you're for a lot of people, that is like a
Uh-huh.
big chunk of their assets, and that
Right. That scares me.
and I mean, in a house, I talk about this, we're having these conversations as a family now. A house isn't the most liquid asset, and you want to make sure
Right.
you strategically sell the house so that you don't get screwed when you sell on the selling price. And so the sequencing of all this is where my PM hat comes in,
Right.
just becomes really important to plan for that, because it's not like you're gonna be able to sell the house, get the cash, move out, be able to like have the money ready for your next place where you're going to live. Like it doesn't work on
Mhm.
a dime like that.
Right. I want to say on that, you probably know this, but for anyone who doesn't know this, it's really a big factor. A lot of parents have been in their house for, let's say, 50 years. And depending where they are in the country, in some areas of the country, I mean, I would imagine probably everywhere, but let's say someone's in California and they bought a house for $50,000, 50 years ago, and now the house is worth $2 million or whatever it
Yeah.
is. In those scenarios, you have to be really careful because you probably know what I'm going to say, but
Yeah,
if,
I know exactly
and
where you're going.
if somebody, if the house gets transferred to the child or it gets sold before the person passes away, then you're looking at a humongous tax bill
Yeah.
versus waiting to sell the house until the parent passes away, and then the child or whoever's inheriting the house will get what they call a step up in basis.
Yep.
So the house that was purchased for 50,000 and had a $50,000 basis now will get whatever the sales price was, or the range of the sales price, that will become the basis. So you have to be really careful. And I'm not an attorney, I'm not a tax person, but well, I'm an attorney, but not practicing attorney, but I'm not a um, estate planning attorney, and I'm not a
You
tax
basically just want to
advisor.
talk to someone who can
Talk to
walk
a
you through
financial
this.
advisor and an estate planning attorney, and just make sure that before you make the move of selling a house before the parents have passed away, you find out what the situation is, because I've heard horror stories of people having these gigantic tax bills,
Yeah.
and it can be avoided. And so there are a lot of different tools out there. I mean, the reverse mortgage is the one people know most about, but there are also some other ways other than reverse mortgage where I know some folks who have creative ways to borrow against the house's equity, if they're in the scenario of needing care and they don't have long-term care insurance. So speak with professionals before just willy-nilly just, selling the house or taking drastic steps that could have really big implications. It's really, really important to not try to DIY on this.
Yeah. So, I mean, what we're saying here is that, like, and you don't want to be DIYing while you're dealing with the stress of the situation as well. Like, you want
Right.
to, these are difficult conversations, whether you're having them with your parents or you're having them with your spouse or like your siblings about your
Uh-huh.
parents. These are very challenging conversations. I
Yes.
actually want to talk a little bit about, women outlive men,
Yes.
right? There's the gray divorces
Yes.
thing going on. So let's say you're a single woman. Are there any specific considerations one should be thinking about with a long term care plan?
Great question. So I would say the first thing is it's really important to get long-term care insurance if you're able to. If you're single, because you know, what are you going to do? Like if God forbid, especially for folks who don't have kids, it's really a big deal. Or if their kids are not nearby or not willing or able to do it, or if maybe you just even if you have kids and you just don't want them to be in that role, I think it's incredibly important to look into the different options that exist. There are different types of plans within long-term care. Some of them have this is a little bit in the weeds, but some of them have what's called reimbursement, which is you have to use a licensed caregiver and then they reimburse you for whatever the care is. Other types have what's called indemnity, where they just will give you a check and you can hire whoever you want. You can hire a family member, you can hire a friend. They don't have to be through an agency, but there's more paperwork involved in that. Some folks argue that for somebody who's single, they might want to go with the reimbursement model. So there's someone checking over everything to make sure that there's not fraud involved. Because if you're, if you have to do the reimbursement, you have to send receipts to the insurance company, and the insurance company can look and say, okay, well, why did this aide spend 16 hours at the grocery store on Tuesday? Doesn't seem right. Or they can, kind of have some oversight. So I'd say a plan that has a reimbursement model is a good thing to think about for that. There are some companies that are better than others as far as the claim support that they offer. So if you have a niece and nephew or someone who's going to be stepping in to help when you first start needing care, look to see what kind of claim support the company has to see if they're going to be helpful because, getting the money is great, but if you've never dealt with this before, it's kind of like being in a foreign land, not knowing the language. And so, looking at the different companies.
I was
Yeah.
going to ask you about reimbursement versus like assignment of benefits type of thing, where,
Uh-huh.
like, for my dad to have to manage like the billing and the invoicing, like, he'll get the reimbursement and then he
Uh-huh.
pays. Like, we're having that discussion on whether we want to take my dad out of it and then we get a copy of the invoice that the at home care agency sends to the insurance company, right?
Uh-huh.
To evaluate if that's going to be better, that like my sister and I, or it would be me, like I'd audit
Uh-huh.
it to make sure that nothing seems out of line type of
Right.
thing. Just because
Yeah.
my
Uh-huh.
dad's not great with money. And also, he has so much on his plate that I just don't think it's advisable for him to deal with that. I'm then curious about is we have medical directives and powers of attorney for my parents.
Mhm.
How do you see that? I mean, I know you're not a practicing attorney, but obviously you are an attorney, right? How do you see that playing out in kind of like the ecosystem of getting all this set up, like with a long-term care plan?
Right. Right. I think it's incredibly important for everybody, frankly, at every age. Once somebody hits 18, they should have a power of attorney for both financial and health decisions because anybody at any point could be hit by a bus and be in a situation where they couldn't
Right.
communicate and they could have a problem. So I'd say like it applies for everybody, but especially, as folks get older, it's extremely important because if there's not something in place, then could be a situation where you have to go to court and get a guardianship, which can be extremely time consuming and costly. I mean, huge cost, huge headache. As bad as it is dealing with aging parents and the long term care forms and all the other things, if you first have to hire a lawyer and then go to court to be appointed so that you can make the decisions for your parent, I mean, that's just a nightmare. So
Yeah.
it's crucial that even if you have to go on LegalZoom and do it or go somewhere, I mean, I don't have any affiliation with them, go
Yeah.
someplace, just do whatever you have to do, get the power of attorney, get, for healthcare and for financial. I mean, that's almost more important than a will because,
Yeah.
if somebody can't speak for themselves and you need to get access to money and you can't get it because there's
Yeah.
not a power of attorney or you can't give, you can't let them know what their wishes are as far as do they want to be, they want a DNR, do they not want to be resuscitated if something happens, or what kind of care do they want if something's really dire? I can't say enough how important those things are that get those in place yesterday.
Yeah, we had an attorney on, and she was actually of the similar mindset of the power of attorney is almost more important than the will. Everyone
Hmm.
focuses on the will,
Yeah,
because of the assets,
I
but
agree.
really it's what happens when the event happens,
Hmm.
um, until the person passes away, which is the diciest,
Yeah.
and the most fraught. So then I want to close out with this question around insurer ratings, because you
Okay.
alluded to this earlier with some of these facilities going bankrupt, right? But
Hmm.
obviously, we've had some fraud in our financial system. I mean, I certainly worked on Wall Street when banks went under. And
Right.
what about these insurance companies? How do you take that into consideration when you're going through that with a client to kind of help them understand like the financial solvency risks with a particular insurer?
Right. Well, I'll only work with the highly rated companies for that
Hmm.
reason. There's some out there that have some options for folks who have health challenges and might not be able to qualify and they're not as highly rated, but they might be more lenient with underwriting. I always hesitate with anything that's not highly rated because, you know, it, what's the point of doing it if they might not be there? So that's a really big concern to make sure that the companies are highly rated and that they're strong and you can count on them.
Does that vary state to does their solvency vary state to state based on state regulations, or is that a
Um,
federal thing?
Not so much. I think well, there are these different rating agencies that are out there, and I don't think it's state related. I think it's they just, the different rating companies will rate the different companies. One question I get all the time is, well, how do I know if I put my money in here that I'm not going to lose all my money? And one thing that's good with insurance is that it's highly regulated, and each state does have an insurance commissioner. And in the absolute worst case that an insurance company went under, the state insurance commissioner would assign the contracts to other insurance companies to administer the contracts. And there's usually a provision that says something like you're covered up to around 300,000, or there's a certain
So it's like
dollar amount.
FDIC.
Sort of. I mean, it's not exactly the same, but there's a lot of regulation
Mhm.
that's there, and to make sure that the companies are in good footing. But, I definitely take that into account, and I'm hesitant to work with a company unless they're highly rated.
All right.
It's
I
a
know
good
we
point.
talked about all the secrets. What other tips that I did not ask about because I am admittedly very new on this topic in terms of
Got
figuring
it.
things out? What are some other things that you want people to know that
Oh
I
my
didn't
gosh.
cover? I mean, there's
Well,
probably
I could
so much,
right.
but and we'll direct people to your website and everything else. But if
Thank
there's,
you.
let's say, three things.
Okay. Well, I'll give you a couple of different things for if you are shopping for insurance, and then I'll give you also for somebody who already has a policy.
Okay, great,
Okay.
perfect.
So if you're shopping for long-term care insurance, I highly, highly, highly recommend going to a specialist. It doesn't have to be me. It just has to be somebody who spends a lot of their time doing long-term care insurance and not just an advisor who dabbles in it. And I say that because it's not that this area is necessarily difficult, but there are lots of different products, there are a lot of nuances, and changes come along, different products come along. Different companies have different underwriting requirements and underwriting. And so there's some advisors who just have one product and that's their go to for everybody, regardless of their situation. They always use XYZ company. And that really scares me because a lot of times what happens is if that company isn't suited to the client and the client gets declined with long-term care insurance, if you get declined, you either can't get long-term care insurance or you may have a very hard time getting it in the future. You might have to wait a long time. So it's incredibly important to do work on the front end. So if you go to somebody and they say, oh, you should get this policy, here's the application, and they don't ask you about your health, you should run
Okay, that's a great
because
tip.
that is just, I mean, above all else, because here are a couple things that can come into play. Like, let's say somebody's in physical therapy, they're going to either get declined or postponed until they're dismissed. So if the advisor doesn't ask, are you in physical therapy right now? That's right off the bat something that's gonna cause a problem. If somebody doesn't, like, you need to find out about, what medicines is somebody taking? What's their health condition? What health situation? Are they having any procedures coming up? You just need to find those things out ahead of time, and what I always do is if someone has a situation other than just maybe taking thyroid medicine or taking common blood pressure medicine, if someone has anything the least bit out of the ordinary, I anonymously provide that person's profile to my insurance specialist and they send it to the insurance companies and say, "Would you consider coverage for this person?" It's just all anonymous, so there's no risk of any kind to them. And that way I can say, "Okay, well, this company will consider you, this one won't." And then it's not an absolute, but at least it weeds out the companies that are definitely gonna decline someone, so that when
Yeah,
we do
we had that
apply.
happen with my
Uh-huh.
husband, and it
Right.
saved us a lot of time, in terms of like, because these applications are extensive.
Right. So that's incredibly important to go to a specialist and make sure they ask you about the health and situation ahead of time so that you can do that. And then once you know that, then look at the different options. So I'd say that's huge. And also in being able to select a product that's appropriate and figure out the best funding mechanism. Because we didn't even talk about that, but there are a million different ways of funding these policies today that didn't used to exist. Really quickly, if someone inherits an IRA from a parent from 2020 on, they have to take the money out of that IRA in 10 years now. And if the parent was taking required distributions before they passed, then you have to take required distributions.
Oh, wow, okay.
So it used to be you could stretch it out over your whole life. So if there's a company that has a product where you can just take money from your beneficiary IRA and send it right to the insurance company, and then that can create a plan. And that company happens to have an unlimited benefit. So there's one that still does have an unlimited benefit out there if someone's really worried about that. You can take money from an IRA, not an inherited, just a regular IRA. You can take that and you can fund it. If someone has an old insurance policy that they're not using anymore that has cash value, you can transfer it over, and it's a tax-free exchange, and they can use that to fund a policy. For folks who have autoimmune disorders, I just had some luck recently with two different clients, with one with lupus and one with connective tissue disease, where they usually can't get insurance. There's a new product that's really great for that. So that's an option. So, number two, I guess, would be if you've been declined or if you're concerned about your health, it's worth finding out if there's an option for you, because there might just be an option.
Well, that's, I
The
think,
one
goes
that,
back to
yeah,
your point around going to a specialist in long-term
yes,
care, right?
right,
And
absolutely.
then because they will know to ask you about your health conditions to save you that time and
Right.
money.
Right. And then in terms of somebody who already has a policy, like let's say you've got a parent and they have a policy. Well, first of all, the first thing is finding out if your parent has a policy, because sometimes people don't even know that their parent has one. So I guess
Yeah,
number one would be ask your parent, do you have long-term care insurance? If they have long-term care insurance, see if you can get a hold of a copy of the
yeah,
policy if they happen to have it. It's probably dusty somewhere in a drawer, but find out if they have it. If they can't find the copy, call up the company and get a copy of the policy sent to you. And when you do that, find out what are the benefits today, because a lot of these policies have inflation protection. So let's say 30 years ago it was $50 a day benefit, but let's say if it had 5% compound inflation protection, maybe today it's $400 or $500 a day, whatever it
right.
is. So find out what the benefits are. Find out if there's any provision for home modifications. The older policies a lot of times have reimbursement if you need to put in a stair lift or wheelchair ramps or grab bars. They might reimburse for that. Find out also just, how the benefits work. What's the elimination period? How long do you have to wait before they'll start paying? And just all this, there are a whole bunch of questions that you need to ask. And I'm going to be putting together a document which I can share with you. That will be
Yeah,
sort of a script for people to be able to use to know what to ask the questions. But then, so you want to get the policy, you want to, have a copy, understand the benefits, and then there are two things that you can do that can be really helpful. One is to make sure that someone's designated to be notified if the premiums are late, because sometimes
yep,
when people have dementia and they forget to pay the policy, it can lapse and go just, it can go away. And so if you're notified that it's late, you can, especially if you don't even know they have a policy, then it can
yeah,
be really, that's where it can really come in. And then the other thing is to be listed as a third party authorized to get information about the policy. Because if you call up and say, I would like to find out about my mother's policy, and she can't come to the phone, they may not talk to you.
yeah,
So having
yeah. The
that in
power of
place,
attorney certainly helped with that,
right.
getting that sorted. But yeah, I think all those things are
Um,
really helpful. And then the other thing you taught me when we were in our prep call was about the VA. You
right.
told me about, like, because my mom didn't serve, but my dad served.
Oh, wow.
And so we're checking to see that they do have a long-term care benefit if you served. So that's another thing to kind of use there, right?
Absolutely. It's called aid in attendance. And it really depends if you serve during time of combat,
Right.
then you might have benefits. It's not going to be huge, but if it's a little something that can make a difference.
Absolutely.
Definitely.
Suzanne, this was such an informative episode. I really appreciate your time. I mean, it's a very technical topic. What you cover is very technical, and I appreciate you breaking it down. And we can have you back on as more stuff comes up. But I really appreciate you coming on. How can people find you? Where's the best place for people to find you?
Um, I'm on LinkedIn, or they can go to my website, which you'll put in the show notes.
Yep.
And I'm always happy to have conversations. The way I work is, if I do write an insurance policy, I get paid a commission by the insurance company. So that's how I get paid for it. And so I don't charge for time that I spend consulting with people. So there's really no obligation. It's just a question of your time spent to, if people want to learn about what the options are, I'm more than happy to go over it. And, it is so specific for each person that
Yeah.
it really is, it should be customized and it should be made just for them. It should not be just taken off the shelf and applied the same thing for everyone. That always makes me crazy
Yeah.
when that
Yeah. For
happens.
sure. All right. Well, we're going to wrap up this episode of Going the Distance with Go Long with Suzanne Scheer, talking about long-term care insurance. Going the Distance with Go Long is produced by John Richardson. And remember, it's your life. Go the distance. Go long.